Okay, good day, audience. Assalamu alaikum. This is Mustafa Mirchawala, your SBR, trainer, and today we are going to discuss the remaining area of March-June 2021 past paper. Okay, means question number 3 and 4. Question number 3 and 4. Okay, right? I'm sure you all worked hard a lot this week, and now your confidence must be better than what you were having previous last week. Okay, because you guys are constantly working. Last month everybody works hard. Okay, so it's time to create motivation. It's time to give positivity to each other, right? So let's start. This is question number 3 and March-June 21. Okay, again I repeat one thing. Last time I also said this thing: don't go for perfection, go for maximization. Okay, right? And there are judgmental things also. There are many judgmental things in question number 3 and 4. So don't worry, you may disagree, with certain points. Now, SITCA company is a software development company which operates in an industry where technologies change rapidly. This is a very important point, and I will use this point during the lecture to draw a conclusion, right? Okay, so rapid changing environment, and this is what the real world is nowadays. Extreme changes. Its customers use the cloud to access the software, and SITCA company generates revenue by charging customers for the software license and software updates. So now, very simple model. It's like Microsoft. It's like Apple company. You know, we use Microsoft Windows. And we pay them for the license, right? We pay them for the license, and it gets updated after every few months, because of the technological changes, because of the competition, because if there is a change in Apple, if Apple company upgrades the software, so automatically the Samsung company has to do in return. Obviously Microsoft has to update. So because of competition and because of technological changes, this is very normal. So their model is simple. They allow customers to use the software. In return, customers pays the amount. It's like they are paying the rent. Like this. It has recently, now a different thing. It has recently disposed of an interest in a subsidiary Marriott company. That means selling of shares. So you will get a little bit of consolidation disposal type thing. Okay, and purchased a controlling interest in billing company. So they disposed of control in one entity and they bought control of another entity. Very simple, right? The year end of the company is 31st December X7. Okay, now this is going to be your first paragraph, and this contains 2 requirements. This is the first issue now we will discuss, and this contains 2 requirements. It's the combination of IFRS 15. It's the combination of IFRS 15 and a little bit of IS 38. Okay, now on 1st January X7, that means on the first day of accounting period. 1st January X7, that means the first day of accounting period. SITCA company agreed a 4 years contract with Cent company. That means the seller of services are SITCA and buyer of services Cent company to provide access to license SITCA company software, including customer support in the form of monthly updates to the software. Now, listen, apparently, see on the first paragraph, we also say, apparently it looks like we are providing 2 performance obligation. First thing, we are giving license, and the other thing, we are providing the updates. Okay, monthly updates or like this. So it looks like still many things are left. It looks like we are providing 2 performance obligation. Now, one thing I'm going to tell you in advance, the next paragraph, the paragraph which we are going to study now, relates to stage 2 of IFRS 15. stage 2 of IFRS 15 and a little bit of stage 5, listen. So now you need to decide, you need to judge, you need to conclude that are these two license, providing license and the providing monthly updates, are these two separate performance obligation, or the complete contract is a single performance obligation? Okay, this is for this thing we need to comment. Okay, and definitely judgment is there, Okay, now the total, yes, the total contract price is 3 million for both licensing of the software and the monthly updates. The total amount we are charging is 3 million. Sitka company licenses the software on a stand-alone basis for between $1 million and $2 million for over a period of 4 year period. Now, hold on. We provide license separately. If somebody wants only license, we say, okay, take license. And for this, we charge 1 million to 2 and 1 million, and between 1 million and 2 million depends on the bargaining. Okay. And regularly sells the monthly updates separately for 2.5 million over the same period. Okay. So again, it looks like we have both offers. We say, if you want to buy license, you can. If you want to buy only monthly updates, you can. And here in this question, we sold the complete package. We sold the complete package with license plus monthly updates. Now, very important. The software can function on its own without the updates. Now, this point goes in the favor of two separate performance obligations. This point goes in the favor of two separate performance obligations. It looks like that without update software is okay. Without update software is okay. So that it looks like these are two performance obligations. Okay. So this point goes in the favor of two separate performance obligations. Please don't sleep. Technical issue. Although the monthly updates improve its effectiveness, they are not essential to the functionality. Means it will still function. If you don't update, still it will function. It will function. Now please. However, because of this is the key line. This is my decision-making line. This is the key line I'm going to read. Because of the rapidly changing technology in the industry, we all know this already. And already because of the current environment of the world. Plus on the top of the page, see the top of the screen, see they use this word technology change. So now, because of the rapidly changing technology in the industry, if Cent company does not update the software regularly, the benefits of using the software would be significantly reduced. That's it. This is the heaviest point. This point indicates, let me change the color. This point indicates that standalone license cannot work. Only software without updates is not meaningful. It's not meaningful because there will be a significant reduction in the software benefit. That means these two things are one thing. Use your brain, please. I repeat, because of the rapidly changing technology in the industry, if Cent company does not update the software regularly, the benefits of using the software would be significantly reduced. So that means it won't be beneficial for the customer. So why would the customer buy? Only license? So if the customer wants license, he must buy the monthly updates. So it says it clearly, this point clearly indicates that, listen to me, that only license won't benefit. Only license, please don't write on the comment box. Listen my lecture. The main thing is my lecture. Please try to concentrate. Thank you. Real thing is the lecture. See, if a customer buys on, if a customer gets license only without updates, so he won't get benefit of that, major benefit of that license. See, the word significantly reduce is written. So if he want license, he has to take the monthly updates. So these two things are one thing. These are not two things. This is my conclusion. That's why I will treat, no issue. I will treat it as a single performance obligation. Okay. Yes, no doubt. Some points were in the favor of two separate performance obligation. Some points were in favor of, dear students, look at here. Some points were in favor of starting points, two separate performance obligation as we were providing separately. And the second point, they said the functionality point, that is still it will function. But what you will do with that function if you are not getting the major benefit? So updates are necessary. If you want to enjoy the real benefit. That's why these two things are one thing. So we would recommend as a single performance obligation. Okay. So now listen, no need to split. Open your ears. These 3 million into 2.5 and 0.5, nothing. No need, because this whole thing is same. Now the next issue is, should we book revenue of in terms of point in time or over time? Point in state 5, you have two options. Shall we book revenue point in time or over time? Point in time, over time. Excellent, over time. Why? You remember, for overtime state 5, there were 3 conditions. You need to fulfill only one of them. Out of 3, only one of them. If you are providing such services in which you provide service and other party gets benefit simultaneously, so you need to book overtime. So this is the case with software. On daily basis, they will use the software and they will get the benefit. So this should be spread over time, over the life of the contract. On a reasonable basis, which we also called it like stage of completion, reasonable basis. Okay. And you need to disclose that policy as well. Now, in the year ended 31st December X7, sent company has only updated the software on 2 occasions. Okay, customer asked this update for 2 occasions. No issue. But still, updates are necessary. Because without updates, significant benefits will be reduced. Now, something very technical is coming. This whole part till now was IFRS 15. And now let me change the color. Listen, this part is another requirement. And I'm going to discuss this. It. Don't worry. Let's read the first requirement and let's walk through the requirement. Discuss whether the 4-year software contract with sent company is a single performance obligation in accordance with IFRS 15 with customer, including how the revenue from the contract would be accounted for. Now listen, there are 2 requirements. First is about stage 2. That is this whole contract a single performance obligation or two separate performance obligations? This is stage 2. And then they are asking how the revenue, this is stage 5. How the revenue is stage 5. How the revenue for the contract would be accounted for in Sitka company's financial statement for the year ended 31st December X7. Your answer should include whether the revenue should be recognized at a point in time or over time. Yes, this is all stage 5. This is 8 marks requirement. You can get these marks. Still, you can get this marks. At least those who have studied IFRS 15, they are able to discuss it. Yes, you may conclude wrong, but still you have ability to discuss. You have ability to write stage basics of stage 2 and stage 5 and some discussion. And you know, in my lectures, if you have listened my previous lectures, I always say this thing, that there is a difference between ICW corporate reporting and SBR. There is a big difference between ICW corporate reporting and SBR paper, ACCA SBR paper. In ICW corporate reporting, you take your exam folder and you write from your exam folder, right, in the exam. But in ACCA SBR paper, you copy things from the question. Many things you copy from the question. This is routine. This is routine. If you see the past papers, many times you copy things, many sentences you copy from the question, right? Okay, now let's start. This is the solution of A. First of all, we are writing the state the rule like it's knowledge. Knowledge, then application. Knowledge, then application. Kaka. K-A-K-A. Knowledge, application. Knowledge, application. First knowledge, then application. Listen. IFRS 15, revenue from contracts with customers state that goods or services which are promised to a customer are distinct, means separate, if both of the following criteria are met. You know that the customer can benefit from the goods or services either on its own or together with other resources. This is the point which is not meeting. This is the point which is not meeting in this question. Customer can't get major benefit. Customer can't get major benefit from the software license alone. That's what we proved in the question. Then the entities promise to transfer the good or service to the customer is a separately identifiable from other promises in the contract. Yes, this condition we have met. That means you have promised these two things separately. These things are written separately, and there is evidence that they are going to be provided separately. So I would say in this question, you are meeting point B, but you are not meeting point A. So because of not meeting point A, both points must be met. See, both points must be met. Because of not meeting point A, you will conclude that it's a single performance obligation. Okay. Now let's start the case. It's about gathering evidence now. In this case, SITCA is providing two services, that is providing the license for the software and monthly updates. The determination of whether the license and updates are separate performance obligation requires judgment. See, this is how we started. Now, no conclusion till now. Just we have written that this is a complicated case and it requires judgment. Okay. In this way, we make the mind of examiner. That we may be wrong. At the end of this question, this part, I'll tell you one special thing, which is written in the marking scheme, of this, especially this part. And that things is equal to the examiner report, matches with the examiner report. However, it appears that the updates does not change the functionality of the software, or is essential for its functionality. See, still these two points goes in the favor of separate performance obligation. Now, the software worked effectively without frequent updates. However, see, this is the real story. However, given that technological environment is rapidly changing, the updates may be essential for operating effectiveness of the software. As if the software is not updated, this may reduce its operating effectiveness. Okay, so through this point, we have changed the mind of examiner. This is not difficult, very simple, especially when you are with your teacher. This is very simple thing. This is very simple thing. Okay, now SITCA company should consider not only the frequency, but also whether sent company accepts the updates. Updates are made available every month. Yes, it is available every month, but sent company has only updated its software on 2 occasions, which seems to indicate that the software is functional without updates, right? But still that sent company is using it. Although 2 times out of 12 times, In a year, there are 12 months. Two times they use, but still they are using. Okay. Now, to conclude, the benefit which Send company could obtain from the license over the 4-year term without the updates would be significantly reduced. See, this is the point we have copied from the question. We have copied this point from the question that without update, your benefit will be significantly reduced. And when a party is not getting significant benefit, why would he pay? Why would he buy that product? Why would he rent that product? It will be useless. It will be useless. The contract to grant the license and to provide the expected update is a single performance, single promise to deliver a combined item to Send company. Now, this is the conclusion. This is the final conclusion of stage 2. This is the final conclusion of stage 2. Till now, we discussed stage 2. Till now, we discussed stage 2. Now, if you remember the requirement, if you guys, please sit with confidence. If today we are going to discuss very excellent standards. If you remember the requirement, not only stage 2 but also stage 5 you need to discuss. So now I just told you this we'll be booking revenue over time, because as we are providing the service, the other party is getting benefit, so overtime revenue is suitable, right? As Send company is the customer, simultaneously receives and consumes the benefits of the entity's performance as it occurs, as and when it occurs. The performance obligation is satisfied over time. As the contract is a single promise, the revenue of 3 million, complete 3 million, will be allocated over the 4-year time, right? So this is something about stage 5. This is something about stage 5, right? Now, Sitka company should disclose the method used to recognize revenue together with the judgments used to determine the timings of the satisfaction of performance obligation. Now, wait, the objective of financial statement is to show clear picture to shareholders. Okay. So even if you are booking revenue over time, you need to disclose the basis. You need to disclose the basis or judgmental points which you have used to decide how much revenue to be booked each year, Okay. So this disclosure is required. Okay. Now, one thing extra, even if you don't write it, still the examiner can understand. It should not and cannot allocate 2.5 million to the monthly updates and the residual amount to 0.5 million to the license software, as this does not faithfully reflect the standalone selling price of the software. First of all, this is a combined contract, so no need to separate. This is a single performance obligation, so no need to separate between 2.5 and 0.5. 2.5 and 0.5, this whole scenario is single thing. Single thing. Okay, right? Now, one thing, that's the end of this only 8 marks part. Listen, one thing. If you see the marking scheme, I said once, there is one thing what we call headroom. Yes, headroom. In SBR paper, there is a headroom, and one interpretation of headroom is multiple solutions are allowed. Multiple solutions with arguments. Are allowed. So examiner has written in the comment section that if somebody uses the first 2-3 points, remember the functionality and remember we are providing separately, and start building the case in that way, still we'll give them marks. Still we'll give them major marks. Yes. Okay. But then you need to prove in that way. Okay. So they check your knowledge. Your application, that how you put your case. That's all this paper is all about. Okay. So did you understand this thing? Kindly comment, one comment just for the feedback. That's it. Just for the feedback. Now, the next point, just think, very simple point. Just 1 minute, I'm silent, but you can read this last part. Read the last part and requirement. Second requirement, 4 marks. Please read it and think about a claim. Now listen. Now listen to me carefully. You know, we use Microsoft Office, but first of all, let's read the last line. Send company must access the software via the cloud and does not own the rights to the software, because this software is not send company software. This software is not send company software, not send company software. Okay, this software still belongs to Sitka company, and Sitka company is providing to different people like Microsoft. We all uses, maybe you guys are using the Microsoft Windows, I'm using Microsoft Windows. So we just pay rent to Microsoft company for every year. Even the every year it is paid every year if you are using proper legal licensed Windows. So you need to pay every year the charges. It's like $30 or $20, some charges, which include some, like Zoom. Yes, excellent. Like Zoom. So right now we are using Zoom service. Right now we are using Zoom service, and we just pay for this service. That means we are just using the services. That's it. We are not the owner of Zoom. We have no rights to sell this Zoom software. We have no rights to sell the Microsoft Windows. No, that's not my company. That's not my software. Yes, I agree that there are some made to order softwares which we call bespoke softwares. I think this is the name, bespoke softwares. If I'm wrong, please forgive me. In that case, we go to a software house. Yes, tailor-made. In that case, please students look at me. In that case, we go to the software house and we tell our specifications, and they specially make a software for us, and they transfer this software to us, and we have all the rights. Now nobody else can use this software without our permission. Now these are proper rights. These are proper rights. So in that case, it's my intangible asset. In that case, it's my intangible assets. Right now, this is the intangible asset. This is the intangible asset of Sitka company. It's not sent companies. It's not sent company. It's not Sent company's intangible asset. Sent company is just renting it. Best word is renting services. So if you rent something, if you take services from some company, then that's not your thing. That's not your thing. Okay. So that's why it's not intangible asset. Now go slow. Read the requirement. Examiner has openly told you two things. Discuss briefly why the right to receive access to Sitka's company's software is unlikely. See, they have told you the answer. You just have to gather arguments now. Even the conclusion is ready. In the question, they have told you it's unlikely to be accounted for as an intangible asset or a lease in sent company's financial statement. So the sent company is receiving services from Citica company. So these services are not intangible asset. They have openly told you. Just you give the argument. Number two, it's not IFRS 16 even. It's not IFRS 16 even. Okay. Now listen the arguments. If you remember IS 38, basics of IS 38, for IS 38, there are few things, there are few criteria. Number one is identifiability. Number one is intangible asset must be identifiable, separable, right? It should be separated from other transactions. Number two, you have control of the economic benefit. You have control of the economic benefit. You have control. Definitely one more thing, non-monetary, I'm not discussing here. Intangible asset should be non-monetary as well, but this point is not necessary here. So identifiable and the economic benefits must be in your control. So yes, you can say that this contract is identifiable, but we don't have control of the economic benefit because we don't have rights. We don't have rights to sell. We don't have rights to sell, or we don't have rights to rent it to anybody. So that's not our asset. We just renting the services. So that's why this is not our intangible asset. This is not our intangible asset. This is not our intangible asset. The first thing. Second thing, for lease, if you remember lease, you must have right to direct the use. Remember this word if you have read the notes, if you have read the articles. So this, if you have even read the study text, you have right to direct the use. We don't have that thing. This is a ready-made software, and the functions of softwares are defined by the software company. So we have no rights to change it. We have no rights to change it according to our wish. So that means we don't have right to direct the use. So that's why we won't be applying IFRS 16 here. Now, one extra thing which they haven't asked, but still listen. So, sir, as we have paid for 4 years, as we have paid, for example, the total contract price is 3 million for both. Yes, it's not written here that 3 million is paid immediately or not, but let's assume a separate thing. What if sent company paid 3 million on the day one for next 4 years? So this will be treated as a prepayment. Like sometimes we do. We pay electricity bill, or we pay other expenses in advance. So when we pay, sorry, somebody has written deferred income. No, deferred income for that party. Please, for Citica company, it's deferred income. We are solving for sent company. Please, students, be careful. We are studying for sent company. So if sent company has paid advance for 4 years, so that means paying advance expense. So it's prepayment. So yes, prepayment is your asset, and now you will spread it over the 4 years, and you will transfer some amount every year in the PNL. If you have paid at the beginning of the period. If that is the case, then this is the answer. Right? Okay. Now let's read it. Now, As per IS 38, intangible assets should be identifiable, and there should be control over the resource and existence of future economic benefit. The current arrangement with Citica company is likely to satisfy the identifiability, yes, and existence of future economic benefit criteria. Obviously, we will get the benefit, but it is questionable whether the control criteria is satisfied. IS 38 states that entity controls an asset if the entity has the power to obtain the future economic benefits flowing from the underlying resource and to restrict the access of others to those benefits. I just told you the example of bespoke software. If this was the bespoke software, then yes, we have taken the rights and nobody else can use it. In that case, that this will be our intangible asset. Now, send company does not own the rights to the software at any time and instead pays Citica to access and use of its software. So normally it's like Microsoft Windows, for which we pay annual fees or quarterly fees. That's it. So it's your expense. Now, in the requirement, they ask two things. The contract is not a lease. In accordance with IFRS 16 leases, as send company does not have the right to direct the use of an asset by having decision-making rights to change how and for what purpose the asset is used throughout the 4-year contract, because all the functions are ready-made by the Citica company. So it's not your discretion. To change the complete software. It's not your discretion to change the complete software. Okay, right? This was the solution of part B, the 4-mark solution. Are you guys with me? Please? Are you guys with me, please? Now we are moving to the next part of this question. To the next part of the question. Please be confident. Confidence is the key. If I share my experience, I have seen people working hard a lot, 6 months, 8 months, still they fail because no confidence, because negative thinking, because thinking that what I'm writing is wrong. For example, if you write something, be confident that you are right, you have argument. You have argument, okay? No issue. If you study last month, we all study last month. Somebody is commenting that we study only last month. Last month is enough. If you have confidence, and if you don't have confidence, last 6 months are zero, nothing. You useless. There are people who clear paper in 10 days. I know many people. Only the confidence. Even I cleared, even in back at my time, I cleared papers in 1 week, professional papers. I'm talking about professional paper, 1 week, just because of the confidence. Now, if you remember the last week classes, yes, it is the expense of the company. Now listen, students. If you remember this paper, I'm talking about March, June 21. Listen, in the last week, we did the first part. So remember when we were doing consolidation part, I told you that consolidation was very easy. This question, consolidation is like F7 level, FR level consolidation. They give you simple IFRS 10, simple goodwill calculation, or simple fair value adjustment, and IFRS 13 and all. This all they tested in consolidation. And IS 19 is not consolidation. That's separate thing. So just think to balance out paper. See the taste of examiner. They are examining one disposal case here. But for that, you must understand the basic rules. at least you must know the basic rules of step acquisition and disposal. Okay. Now, one thing, if you remember or not, there is one thing which we call individual books of parent company, and the other thing is consolidated books. These two are separate things. One is individual books of parent company, and the other thing is consolidated books. Okay. For consolidated books, we apply IFRS 10 and IFRS 3 business combination. IFRS 10 tells us whether we have control or not, just giving you a recap. And IFRS 3 business combination deals with all practical consolidation, P2S, S2P sale, fair value adjustment, goodwill calculation, different types of consideration, blah, 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 blah. Okay. So this is IFRS 3 and IFRS 10. Both deals in consolidation. Both deals in consolidation. Both deals in consolidation. Okay. Now, there is one more standard which we call IS 27. There is one more standard which we call IS 27. And that is about separate financial statements, means separate financial statements of P company. Separate financial statements of P company. So in separate financial statement, yes, we don't do consolidation. I agree. In separate financial statement, we don't do consolidation. We just write the investment in one line. If you have shares of subsidiary, if we have shares of subsidiary in individual SOFP, of P company, we'll just write investment. That's it, one line investment. Now, for that thing, one new thing I'm going to tell you. In individual books, see, if you have done investment in subsidiary, maybe something new for you. If you have done investment in subsidiary, so in P companies, individual books, you have three options. You have three options to record. You have three options to record it. Wait. Number one is you can record that investment at cost. You can record that subsidiary investment at cost. Please don't sleep. Okay. This treatment you used to follow in F7 level. In F7 or FR level, the intermediate level, there were no complications. So normally, investments are recorded at cost in the individual financial statement of parent company. Okay. You have second option. You can record it at fair value using IFRS 9. You can record the investment in subsidiary or investment in associate at fair value using IFRS 9. Remember the two categories, fair value through P&L or fair value through OCI, as you wish. And there is one third option as well. Is available, that you can record using equity method. IS 28. Okay. There is one third option available, that in individual books, parent company can record investment in subsidiary as investment in associate, and in one line you can apply equity method, equity accounting, right? And what is equity accounting? Let me tell you. Original cost, COI, original cost plus post profit share. Okay. So my dear respected nice students, you have these three options. You can pick any of them. For individual books, I'm talking about parent companies, individual books, you can opt one of them. Okay. Right. Now, one more thing, because I teach in this style during my normal classes, that's why I'm using the same words. Listen, there is one very important thing which we call change in status. There is one very important thing in SBR level consolidation, this advanced level consolidation, when we study step acquisition or disposal. Teacher uses one word, changes in status. What is changes in status? For example, you have 70% shares. Yes, one student using my words. Thank you. For example, you have 70% shares, you have control of one company, and now from 70% you are coming to 30%. So you are jumping from subsidiary to associate. This is change in status. Or from 70% you are coming to 10%. From 70% was control and 10% is just trade investment. So this is also change in status. So whenever, open your ears, whenever there is a change in status, you need to book gain or loss in P&L. Because it's like disposal. It's like disposal of your status. It's like you disposed of your control. But yes, there is one very super hit case. Please, students, these are ending days and you are getting, I'm revising you things. There is one very, very super hit case. I'm sure you all know, sub to sub. There is one very famous case which we called sub to sub. For example, you had 80% shares of the subsidiary and now you just disposed of 20%. So you are coming from 80 to 60, 80 to 60, or 60 to 80, 80 to 60, 60 to 80. So this is sub to sub. And I hope you remember teacher writes here that there is no change in control or no change in status, So when there is no change in status, so in this case, you don't book anything in P&L. Remember? So I'm sure you know this thing. You have little idea of this topic. Okay. And when I teach in class, sorry, because all students who are attending this session, they are not my student, but it doesn't matter. I will still send my message. Whenever there is a change in status, like you had 70% or 60% shares and you disposed of 50%. You had 70%, you disposed of 50, or you had 70, you disposed of 60. So from 70 to 10, from 70, you are coming to 10. So it's like you are coming from a big car to small car. You change your status. You have sold the big car and you bought the small car. You sold your big car and you bought small car. So now that small car will be recorded at fair value. Just think it's an exchange deal. Now this small car will be recorded. The remaining interest will be recorded at fair value. Or I have one more technique to send the message. Wait. Just think you had 70%. You had 70% and you sold 60% and now you have only 10. So just think it like that you sold complete 70 and then immediately you buy back 10%. So when you buy back immediately 10%, you will buy back at fair value. So the remaining interest must always be recorded at fair value. I'm sure these are ending days. You must know this treatment, but still, if you don't know, still you can pass. Because if you have confidence, you can clear. Okay, let's try this question. This is again practical question, practical discussion, practical based discussion. Now, Sitka company prepares separate financial statements in accordance with IS 27 separate financial statement. That's a very simple message, self-explanatory. At 31st December X6, it held 60% of the controlling equity interest in Marriott company, yes, and accounted for Marriott company as a subsidiary. Obviously, 60% is your controlling interest and that's subsidiary. Now, let's talk about the separate financial statement. This question is about this portion. This part is about separate financial statement. In its separate financial statement, Sitka company had elected to measure its investment in Marriott using equity method. So right now in the individual books, out of the three options, we are using the equity option. In the individual books, we are using the equity method option. Okay. On 1st July X7, Sitka company disposed of 45% of the equity interest, means from 60 Out of 60, we sold 45. So now we have only 15% left. Now we have only 15% left. Now check the first consideration for 10 million. This is the first consideration you receive. This is the first consideration you receive, 10 million. So just use your brain, bank debit. Because it's my personal choice. I enjoy this topic doing with double entry. I enjoy this topic with double entry, but everybody has its own choice. There are students, they are comfortable with the statement working. So no issue, no issue. I'll teach both. And lost control. Yes, you sold your control. That means the change in status. And whenever there is a change in status, things goes in P&L. Gain or loss goes in P&L. Now, at the date of disposal, the carrying amount of Marriott company in its separate financial statement is 12 million. The final carrying value was 12 million. So yes, this carrying value means this was your old big car. This was your old big car, and now you sold this big car. So you will credit this 12 million. You will credit this 12 million. Okay. Now, after the partial disposal, Sitka company does not have joint control nor significant influence. So now, simple, you have come to trade investment. You have come to IFRS 9. Now you don't have any options. You have come to IFRS 9 over Marriott company, and its retained interest of 15% is to be treated as investment in equity instrument. Yes, normal IFRS 9 equity investment. And yes, we all know for IFRS 9 equity investment, we have two options. Fair value through P&L and fair value through OCI. Okay. At 1st July X7, the fair value of the retained, see, this is the small car of 15% in Marriott was 3.5 million. Yes, this will also be used because I just told you, I gave two arguments, two examples, that whenever there is a change in status, you record the remaining investment at fair value, or for some students, you record this small car at fair value. Sitka company wishes to recognize any profit or loss on the disposal of the 45% interest in the other comprehensive income. No, wrong, total wrong. Whenever, I just told you, we just discussed, whenever there is a change in status, these things goes in P&L. Whenever there is a change in status, these things goes in P&L. This gain or loss goes in P&L. Yes, one thing I can say, that for example, from now onwards, you are using fair value through OCI. From now onwards, if you are using fair value through OCI, then you will record the future changes in OCI. Yes, future fair value changes in OCI. Then you will record the future changes in fair value in OCI if they have elected. Yes, if you have done election for fair value through OCI. Yes. Okay. So now read the requirement and then we'll discuss. Don't worry. And I'll make the entries even. Discuss and demonstrate how the disposal of 45% interest and the retained interest of 15%. So we need to discuss about the 15% as well. In Marriott company should be accounted for in the separate financial statements of Sitka company at the date of disposal. That's it. This is the requirement. Giving you 1 minute to settle down. If you read the question, you can read. No need to rush. Relax. Demonstrate means show the calculation as well. Okay, let's start the case. If you want to go with double entry, let me tell you with double entry first. Let me show you the double entry. You have, if you want to take the pick of this question, you are allowed. You are allowed, because I'm going to move the screen. If you want to take the picture, you may. I'm going to move the screen now. Okay. Now listen. Those who want to go with double entry, this is the double entry. Debit bank or cash 10 million. We receive bank or cash 10 million. And you sold your big car and you got a small car. So investment remaining. This is 10 and this is 3.5. Okay. So in easy words, you receive two things. One, you receive cash, and the second thing, you receive the small car, the remaining investment. And what you lost, you lost your carrying value. You lost the carrying value last day was 12 million. And you were using it equity method, using it through equity method, 12 million. Can you see a balancing figure? Can you see a balancing? How much is the balancing figure? There is something left on the credit side. There is something left on the credit side. It's 1.5, and this is gain. This is gain. This gain will go in the P&L. This gain will go in the P&L. This is how the entry, we'll make the entry. This is how we make the entry. Okay. One more method. One more thing you can do. One more thing you can do. Wait. You will write, if you want to do with the statement, you will write proceeds. Because I just wrote the name of investment and associate, because we were doing equity accounting. That's why. If you just, you can also write, if you have allergy, wait. Investment existing, that's it. It's also enough. Now, if you want to do with the statement, there are students, they like statements. So proceeds is how? 10 million. Fair value of remaining interest okay, this is the consideration. You will deduct less carrying value of existing investment. It was 12. So finally you will get the gain of 1.5. This is gain. Okay. Got it? So whatever method suits you, you can do it. No issue. I like double entry personally. So I make entries for this topic. This way is also correct. And I'm sure you recalled it. You recalled it in your normal classes of SBR. You have definitely done this thing. Now let's walk through the solution. Listen. IS 27, start please. IS 27 separate financial statement requires an entity which prepares separate financial statement to account for investment in subsidiaries, joint ventures and associate, either at cost. This is the first option. In accordance with IFRS 9, this is the second. And the third is using the equity method as described in IS 28, investment and associate. Okay. So you have three options. I already discussed this thing using 1, 2, 3. Already discussed this thing. Okay. Now, after the partial disposal, Marriott Company is not a subsidiary, not a joint venture, not an associate of Sitka Company, but is an investment in equity instrument. See, it's a pure change in status. It's a pure change in status. Okay. So now definitely if it's a change in status, so you need to book gain or loss. You need to book gain or loss in P&L, as well as you need to revise the accounting, because now you can't think of equity accounting. This is normal trade investment. When your holding percentage is normally less than 20, so it's not your associate even. So now you need to change in accounting. Therefore, IFRS 9, from now onwards, IFRS 9 is used to account for the retained remaining interest. Okay. Investment in equity instrument should be measured at fair value. Yes, we all know IFRS 9 says to record at fair value with two options. Number one, fair value through P&L, and number two is fair value through OCI. Listen very carefully. Fair value through P&L is the default category. Fair value is the P&L is the default category. If you won't say anything, it will be recorded as fair value through P&L. It will be recorded at fair value through P&L. But if you do, listen, if you do election, and if this thing is not held for trading, if it's not for routine trading, then you should do election. You can do election, and then you can record it at fair value through OCI. Now read it. However, IFRS 9 also states that an entity can make an irrevocable election at initial recognition to present subsequent changes in fair value in other comprehensive income. Okay, this can only occur if the investment is neither held for trading. It's not held for trading. It's not held for trading. In this case, Sitka company could make such an election at 1st July X7. Obviously, the day you will change the status, after that you can do election after that. So this changes in fair value to be taken to OCI will go for future, not at that date, not for this disposal, okay? Now, IS 28 specify how an entity should account for a transaction which results in discontinuing the use of equity method because the investment ceases to be an associate or joint venture, but retaining an interest, which is a financial asset. Okay. So now this thing is no more associate, no more joint venture. It's normal equity investment. Here the entity recognize in profit and loss any difference between this is all I made the entry for. Wait. This is all I made the entry for, right? You can read it. Fair value of remaining interest plus proceed less carrying value, okay? Thus, Sitka company would make a profit of how much? 1.5 million. We have already done it. Through statement as well as entry, please. This applies regardless of whether the entity elects to present in OCI subsequent changes in fair value of the retained interest. Sitka company should only present any difference in OCI to subsequent changes, means future changes. If let us say you opt for fair value through OCI from now onwards, so yes, future fair value changes will be reported in OCI. This gain or loss must always go in P&L because this is the case of change in status. Now, final dialogue. Difference is not as a result of change in fair value, but instead results from a change in the measurement basis status of the retained interest when an entity loses the control of an investee. You can also write here, the word changes in status. Okay. And one more thing, try to accept this. If you can't write like this, no issue. Write 70% like this, 60%, it's okay. Plus, I have also given you the facility. You can send your solutions, we'll mark it, we'll give you feedback. And you know, the objective of this service is you guys start practicing it, because many students, they don't even practice before exams. This is a reality. Even you guys know this. Many students, they do the question first time in the exam. So at least you guys started writing it, typing it because of this service. Did you understand this question? Please. Okay. Now, one super easy part is super easy part is, listen, IFRS 13. And now, you know, since years, I've been saying this, that in UK, many trainers, they say this in their class, that examiner wants to test fair value. This is the hottest issue. Just think about this past paper. In question number 1, remember in question number 1, when we were doing consolidation last week, there were many things regarding IFRS 13. There were many things regarding IFRS 13. Again, they have tested IFRS 13. So in one paper, sometimes they test 15 marks, 17 marks of IFRS 13. So don't take it as a joke. Read extra articles for IFRS 13. Even if you want to read the book for IFRS 13. IFRS 13 is very, very key standard. Why? Giving you a reason. Because now more than 20 standards required fair value. More than 20 standards required fair value. So without fair value, you can't do accounting now. So examiner can't make paper without fair value. Okay. Now next. Before we start, let me tell you one thing. The biggest announcement of IFRS 13, the main message of IFRS 13, we reduce entity-based factors, we ignore entity-based factor, and we promote market-based factor. For example, if I need to calculate the fair value of this pen, so I would see from the eyes of market participants. I won't see it from my own eyes. No more entity-based, it's market-based. Okay, this thing is clear. Number two, listen. You know, for financial assets, normally there are only one use. Like you have given loan to somebody, so only you will receive cash. That's it. But for non-financial asset, open your eyes. For non-financial asset, more than one use possible. Like from the land, you can do cultivation, you can do commercial work, you can do residential, everything. Okay. So when more than one use possible, so normally, this is the rational behavior for a normal market participant. We always go for maximization. Wait, I give this example to sometimes to my students. Listen, you all know this. If I present you $100 in front of you and one note of 100 pounds, and I tell you to pick one, what will you pick? $100 or 100 pounds? $100 or 100 pounds? 100 pounds. Very good. Rational maximization. So when you are saying the whole market says this, so whole market goes for maximization. So now listen to me. Whenever you want to calculate the fair value of a non-financial asset, you should see with the market participant eyes, plus you should see the highest and best use of that asset. The highest and best use means the maximum fair value, the maximum benefit that can be obtained from the fair value. That you got it now. See, I'm giving you proper lecture, not just this past paper. Now one more thing. Listen. The fair value of this pen, if I sell it separately, it's $10. Listen to me. If I sell this pen separately, video, please let me enlarge the video. Wait. If I sell this pen separately, it's $10. And if I sell this headphones, AirPods separately, this is $20. Okay, this is 10 and this is 20. But if I combine it, let us say there is some synergy in this world. Let us say, if I combine it, I can get $50 for these two. Separately, this is 10, this is 20. Okay. But if I combine these two, let us say there are some buyers in this world, market participant, they can buy it for $50. So now combination is good. Now combining these two will give me benefit, not me, the all market participants, because we all want maximization. Even you guys just comment, you guys just commented 100 pounds. You also want more. You greedy people, you also want more. And I also want more. Not getting. So in order to get the maximum benefit, we group it sometime. We group it sometime. If we are getting benefit, what's bad in it? What's bad in it? You are not getting. Are you getting? Okay. Let's read the question now. It's just a game of seconds for you. Citega company has acquired two assets in a business combination. Yes. In the first line of the question, we read this thing that they have also acquired one entity. And we all know whenever we acquired subsidiary, at this time, we record everything of subsidiary at fair value. Remember fair value adjustment, this is a mandatory thing. So obviously we need to bring everything at fair value. We need to bring everything at fair value. Okay. So now there are two assets in that company which we have just bought, that subsidiary. The first asset is QBook. Which is an accounting system developed by billing company for use with the second asset, which is Best Cloud software. Okay, so there are two softwares, let us say QBook and Best Cloud software. The directors of Sitka company believes that the fair value of the asset is higher if valued together rather than individually. Okay, so yes, we can pair it because we all want maximization. That's very clear. I just told you. Now, if the assets were to be sold, there are two types of buyers that would be interested in purchasing the assets. Okay, so obviously there are two types of buyers. That means these buyers are market participants. Now, one buyer group would be those who operate in the same industry or our same industry and have similar assets. This group of buyers would eventually replace QBooks with their own accounting system, which would enhance the value of their assets. They will enjoy the benefits. They will amend our software. They will buy it from us and they will amend it and they will take advantage. That's advantageous for them. Now, the fair value of the individual assets in the industry buyer, the first industry buyer, same industry, our industry, would be 30 million for QBooks and 200 million for Best Cloud, therefore 230. The real word is 230. Okay, as in the first line, director said that valued together. They have word the value together. So so definitely now we will be seeing the combination. So the combined value is 230 million in first case. In the first case, it's 230 million. Okay. Now, another type of buyer is the financial investors who would not have a substitute asset, for QBooks. They would license QBooks for its remaining life and commercialize the product. They will sell it in market using the licensing thing. Okay. The indicated fair value of QBook Best Cloud within the financial investor group are 50 and 150. Again, don't look at individual values because we have planned for grouping. Now it's 200 million. In total. Take your decision. It's simple. It's very simple. Definitely 230. Yes. Because it's same $100 and £100. Yes, these are easy marks. To be very honest, these are easy marks. You people also do corruption in the exam. That's why you guys got failed. What do you guys do? Because of first and second question, you take tension. You say you can't do anything and then you lose easy marks as well. This is the game. Because of few difficult marks, or let us say 50% difficult marks, you don't catch the remaining easy marks as well. See, this is the reality. And believe me, you have done this thing. You have done these examples are given by teachers in the lectures. The market participant word, highest and best use. You told me the highest and best use in the comment section. Students are commenting about the highest and best use. So these are very common things. Now, how to write? Very simple. First of all, I told you in my classes, I said learn the definition of fair value. Write the definition of fair value. Then discuss the highest and best use thing. Then discuss the highest and best use thing. Highest and best use thing. Okay. With respect to market participants and grouping thing as well. Do add, because this question is related to grouping. And then you discuss these two options and then simply click on the best option. That's it. That's it. Now, one question which is not relevant right now, but still I can answer. It is relevant to check the market in which we are selling. Yes, that's a separate topic. And which is, you remember the principal market and that thing whenever you need to check the market price, principal market and most advantageous market. That's a separate, this is not discussed here. Now, IFRS 13, see, this first paragraph is the definition of fair value. No need to read it. Your time is very expensive now. Just fair value definition. However, IFRS 13 uses the concept of highest and best use. IFRS 13 uses the concept of highest and best use, which is the use of a non-financial asset. I already told you, by, see the word market participants, which would maximize the value, of the asset or group of assets and liabilities within the asset would be used. Okay. So these two things are generally this is the knowledge part. Now let's do application. Even I always say, just copy it from the question. From the questions. Now see, the fair value of the two assets would be determined based on the use of assets within the buyer group which operates in the industry. The fair value of the asset group of 230 million is higher than the asset group of the financial investor of 200 million. The use of the assets in the industry buyer group does not maximize the fair value of the assets individually. Yes, we accept. Listen, we accept the fair value of the second, the fair value of Q book. The fair value of Q book in the second case was 50. Individual fair value was 50. And in the first case, it was 30. But if we see the combined, we need the total benefit. A normal market participant will go for the total benefits. So the total benefit was higher in industry buyers. The total benefit was higher in the industry buyer. That's why we'll report for 230. That's why we'll report for 230. Okay. This is what the last line says. Not getting. Listen, we all want maximization. If that maximization is coming from the group form, that's best, that's excellent. I repeat. If we sell, wait, let me show you the question. So if for somebody, listen. In this part, 30 million quick book here, but the total is 230. The total is 230. Can you see? Total is 230. 30 million for quick books, but the total is 230. In this part, 50 million for quick books, but the total is 200. Total is 200. Just think, now we are not selling them individually, we are selling them collectively. We are not selling them individually, we are selling them collectively. So definitely the collective value is important. And yes, we want the maximum total benefit because both things are owned by us. So maximization in the first case. You are not, did you get it? Did you get it now? Now, after this, we have completed question number 3 completely. We have done question number 3 completely. Now let's take 2 minutes break, and then we'll move to question number 4. But I will just discuss some points, some areas of question number 4. But question number 4 was the easiest. Normally, what is the past practice? Question number 4 sometimes is the most difficult part, and in this question, it is the easiest part for me. I would say it's easiest, some very easy scoring parts, okay? So make your perception that don't, normally when we give introduction of SBR, we say question number 1, 2 is relatively easy and 3, 4 is difficult. But in this paper, 3, 4, for me, it's 3, 4 is comparatively easier. 3, 4 was easier, especially 4. Very general question. This is question number 4. Okay, giving you 2 minutes break, then we'll move to this. Okay, remind me, I have to start recording again. Okay. Welcome back. This is question number 4, and first of all, let me clear. We'll just go through quick. We'll give a quick thing of this question. Okay, right? Okay, you need to do it yourself. I'll just make you understand the concept. Okay, now Collard Company manufactures aluminium products. Collard Company manufactures aluminium products. Aluminium products, and operates in a region that has suffered natural disaster like earthquake or something came in that area. Okay, simple words. On 1st November X7, this is the date. There has been an increase in operating cost as the company had to replace a regional supplier with a more costly international supplier. Now, wait. Let me gather arguments. I know the requirement. That's why I'm gathering argument. Listen, just because of this disaster, now we cannot buy goods from a local supplier. He's not available. So now we have to buy from international supplier. So more freight charges and more freight cost. This will increase our operating cost. Listen, when this thing will increase your cost, look at me. When this thing will increase your cost, so automatically your profits, your future profits will be reduced. And when your future profits will be reduced, your future cash flows will be reduced. And when your future cash flows will be reduced, your value in use, VIU, value in use will be reduced, and reduction in value in use is an impairment hint. So one impairment hint I just gathered. This impairment hint. I just gathered. Okay. Because there is one requirement in which they will ask you, is there any need of impairment testing? So yes, we do impairment testing whenever we get the hint of impairment. So we got the first hint. Let's see, there are many hints. Now, non-current asset. As a result of natural disaster, the share price of Collard Company has declined. Another impairment hint. Listen, as a significant amount of non-current assets were destroyed. Okay, now wait, including the manufacturing facility. Look at me. If you have studied IS 36 in F7 level or SBR level, wait, there is a theory in IS 36 of impairment hints. There are two types of hint, internal and external. Right now, I'm talking about external hints. So, you know, when your share price goes down, when your share price goes down, your market capitalization goes down. When your share price goes down, then your market capitalization, you know, what is market capitalization? Number of shares multiplied by share price. So that means the whole worth of your company goes down. Whole overall worth of your companies goes down. So this is also a hint of impairment. If you remember IS 36, believe me, let me quote you the exact word. If carrying value of net assets is greater than market capitalization, If carrying value of net assets is greater than market capitalization, this is also impairment hint. What does it mean? It means you are reporting your equity for $100,000. You are reporting your net assets and equity in the SOFP for $100,000, but your total shares are sold in market for just $70,000. Your total shares multiplied by share price are available in the market for just $70,000. That means there is something bad in your company. That means there is some bad thing in your company. So again, this is an impairment hint. This decline in share price is again impairment hint. So 2 hints I have given you. Now, the third hint is a significant amount of non-current assets were destroyed. So this is one more hint. Now, in addition, Collard company has suffered reputational damage. Yes, this is impairment hint. Now we know goodwill damage. Yes, nowadays when we listen this, that this entity is involved in this type of thing, low quality food. People create rumors on Facebook, people create rumors on social media. So this is because sometimes your sales goes down because of these rumors. Even this is a proper reputational damage. But if we have seen because of rumors your sales goes down, and when your sales is going down, this is impairment hint. So 3-4 hints we got the international operating cost, increase in operating cost, this is impairment hint. Decrease in share price, this is impairment hint. This disasters, the destruction of manufacturing facility, this is impairment hint. Number four, the reputational damage, this is impairment hint. These 4 points are more than enough. Yes, you need to do impairment testing. You need to do impairment testing. Now wait, you did one requirement of this question. Wait. Read this B part. Read this B part. Let me enlarge. Discuss B part only. Discuss any events affecting Collard company which might indicate that an impairment test ought to be conducted in accordance with IAS 36, impairment of non-current assets. 3 free marks. 3 free marks. Do you understand this requirement or not? I repeat for you guys. Discuss any events affecting Collard company which might indicate that an impairment test ought to be conducted in accordance with IAS 36. Yes, not one event, many events. Increase in the operating cost because of switching the supplier from local to international. Yes, copy paste. Very good. Number two. Somebody is saying, is this FR paper? This is called luck. That's why in the last attempt, students scored 70s. Many students scored 65. Those who didn't come in the class with proper face wash, they scored in 65, 67. Listen. So the point is, number one is the increase in the operating cost. Number two, decline in share price. Number three, that disaster, the destruction of manufacturing facility. Number four, reputational damage. These 4 points are enough. You will get 3 marks. Easy. Now, one more loose ball. One more loose ball by examiner. You can hit the 6, and that's my favorite topic. I love this topic. And if you have. And that topic is basically general knowledge. Even in the examination, examiner has written no need to give any example from the question, just general discussion. Wait, read the A part. Read this. Investors need to understand a variety of factors when making an investment decision. The nature of the companies in which they are looking to invest is an important consideration. Yes. Be an investor, be a CFA guy for just 5 minutes, be an investor, or be an institutional investor. Institutional investors are like mutual funds, pension funds, those who invest the public money in stock markets, in real companies. So investor needs to understand a variety of factors when making an investment decision. The nature of the companies in which they are looking, please concentrate. They are looking to invest is an important consideration, as is the need of the is the need to incorporate sustainability factors into investment decisions. Yes, believe me, this came in previous attempts many times. This is present in articles. Even I have recorded a video for this of previous past papers, and I discussed this thing. Read the requirement, bold requirement. Discuss why sustainability has become an important aspect of the investor's analysis of companies. Note, there is no requirement to refer any exhibit when answer this part A. You don't need to connect with the question. General discussion. General discussion, 4 marks, 4 marks, 4 marks. Let me tell you. Nowadays, investors, before investing in any company, they check these sustainability factors, like how much this company is beneficial for environment. Is this company creating any harm, or is this company involved in any unethical conduct, or is this company's risk is higher? So these things are considered very often nowadays, right? Giving you many examples now. First of all, because there are some investors, those who are called institutional investors. So institutional investors like mutual funds, pension funds, they invest the public money in the stock market. So, they have to publish, they are themselves accountable, and they need to publish the reports that we are investing in this companies. So they need to be very ethical, and they need to be very cautious in making the investment decision plan. So before investing, they make a grid, or what we call, they make a checklist. Yes, they make a checklist that we are investing only these companies who is not involving in environmental damage, those who are not destroying the government laws, this, those who are good for the pollution. From pollution point of view, they are better. So they have a screening strategy. Yes, very good word. They have a screening strategy. They have a checklist before investment. Okay. And now wait, now giving you one example of environmental related thing. Nowadays, this electrical cars thing, the CO2 emission thing, even you guys are ACCA students, and majority of you have studied UK tax. So remember, in the UK tax, the taxation implications are related to CO2 emission rate of that car. So obviously, just think, if a company is not environmental friendly, emitting high CO2, so their taxes will be higher. So when their taxes will be higher, automatically this is a cost for company. And when this is a cost for company, the company profits will go down. So automatically investor will run away. Same is the case with electrical cars, or we call it zero emission cars. Many countries are not even charging import duties. If in the latest budget in Pakistan, they have reduced. Giving you example of Pakistan, there are some students who are attending outside Pakistan, but let me give you example of Pakistan. In the recent budget of Pakistani government reduced the duty of electrical car from 17% to 1%. 17% to 1%. So there was a major price drop in Pakistan. Like, there was a car, you might have heard, Audi e-tron. It was around 17.5 to 18 million rupees. 17.5 to 18 million PKR rupees in Pakistan, but now it's 15 million. So there is a drop of 2.5 million. There is a drop of 2.5 million in the price. It's major for us in Pakistan. You getting? So if you are environmental friendly, you will get benefits. Same is the case. Similarly, with skin related products, you have seen Body Shop and these. They do marketing that we use only only herbal products and we don't use chemicals and like this, which is good for you. So this thing creates this may be used as a marketing tool as well. Okay. One more thing, when you import certain materials, listen very carefully. When you import certain materials, and if they are hazardous or dangerous, so during shipping, I've seen this, I've done this business. During shipping, you need to pay extra insurance cost for that. So those things which are dangerous, which are not environmental friendly, they are automatically costly nowadays in this world. Automatically they have done very extreme implications. Plus, why these things are increasing? Because the weather is also changing. In the last meeting, I think I have given you example that because of global warming, we have seen heat wave in Canada. So obviously now, do you think Canadian government will take action? Definitely. Now they will keep study this topic, and they will put duties on those things which creates this negative temperature thing. Are you getting? Similarly, listen. It also sustainable factors investors check sustainable factors from company to company. For some companies, they check it very carefully, and for some companies, they say, okay, that means materiality level of investors varies from company to company in terms of sustainability reporting. Like if I'm investing in car company, so car company has direct relationship with pollution. So now I will be very careful. Regarding this sustainability thing. But yes, if I'm investing in any other business which is not linked too much with the environment, so my criteria will be a little bit relaxed. Are you getting? Yes. Got it. Then next thing. Yes, giving you one more example for this sustainability. I have seen this thing. There are certain businesses which are dangerous, like tire shop. Listen, like tire shop or selling tires. This is a very big business in US, because in US, each and every household has 3 to 4 cars, average 3 to 4 cars. US is a game of big roads, big roads. So anything you sell it related to cars in US, you earn a lot. That's a very good business. So I have particularly studied, even I have done this business little bit related to tires. So, there are many areas now in US where you don't get the permission to open a tire shop, because they say that it is very dangerous. In case of fire, these tires can catch fire extraordinarily. So when your product is not environmental friendly, you are not allowed to work on many locations, even many cities or like that. Are you getting? So that's why investor hates investing in these types of products. They think that we will have sanctions. Yes, focusing on sustainability reporting might attract more green investors. Obviously, this is the perception. Even nowadays, it's a perception. Nowadays, this thing is used as a marketing tool. For sure, this thing is used as a marketing tool. So you can write many points. I have given you a lot of points. This is just 4 marks game. Okay. So if you get these type of general things, this is very good. You can write a lot. Okay. Now let's come back to the question. Now, the non-current asset of Collard company that were destroyed had a carrying amount of 250 million on 31st October X7, and the fair value of these non-current assets was 280 million based on an independent appraisal shortly before that date. Now the fair value is not relevant. Listen. Very simple. I have this asset C in my hand. I have this asset, and today it's burned. God forbid, it's burned. So it's $0 now. It's 0 rupees now. No value. So I will simply do, Let us say I have recorded this for $10 in my books. So I'll simply write off this like this. Wait, P&L debit 10 and this asset credit 10. That's it. We all know this. This is called written off. This is called written off. That's it. One question. Do we need, very practical thing, new thing. Do we need to conduct any impairment test for this written off? No, it's destroyed. It has become powder. Because of this blast, or because of this natural disaster, this asset is no more. How will you do? Wait, how will you do impairment testing? We do impairment testing through recoverable amount. 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 How do we calculate recoverable amount? Value in use and fair value less cost to sell. You cannot calculate anything for this asset. Asset is no more. Asset is no more. So no more value in use, no more fair value less cost. So it's better don't use the word impairment now. It's better don't use the word impairment now. Just clean your books. Just make the entry. Just make the entry. Just make the entry P&L debit 250 and that asset credit 250. That's it. Okay. This is for the next requirement. This is for the next requirement. Now, few technical basic. Let me use the correct word. Technical but basic. Technical basic things are coming. Listen. In addition, Collard company determined the power plant. You know, I've seen in my country as well. Some big companies has power plant. They produce their electricity themselves. This is very common nowadays. Very common. This is fashion. In addition, Collard company determined that a power plant will have to be closed and decommissioned earlier than previously expected. The remaining useful life of the power plant has reduced from 25 years to 8 years. From 25 years to 8 years. Okay. Non-current assets are valued using the cost model. Non-current assets are valued using the cost model. Now, first of all, I will discuss this decommissioning liability in detail. Don't worry, I will. Let me tell you a little bit basics, very basics, O levels, A levels, basic level, F3 level discussion. You know, this is the case of changes in useful life. This is the case of changes in useful life. And yes, this is also one impairment hint. This is also one impairment hint because previously you were getting benefit for 25 years. Previously, your future cash flows were related to 25 years and now only 8 years. Now you are going to take benefit for only 8 years. So that means automatically your future cash flows will be reduced. Automatically your future cash flows will be reduced. So when your future cash flows will be reduced, your value in use will be reduced. And this is impairment hint. So this is again an impairment hint. First thing, keep it in mind. Keep it in mind. This is impairment hint. The second thing, whenever there is a changes in useful life. So now what you do, today's NBV, you divide today's net book value or carrying value with the remaining life, that is 8 years to calculate future depreciation. And yes, changes in useful life. Changes in useful life is basically changes in accounting estimate. Changes in useful life is basically changes in accounting estimate, So these things are adjusted prospectively. Okay. Now wait. Let me explain you. Let me try my best because this is basic topic. Let me try my best to explain you decommissioning liability. Sometimes we call it compulsory disposal cost. Remember? See, they have given you here. Let me shift the page first. Listen, this is year 0. This is year 25, just for your example. And at the beginning of the contract, we came to know that when we'll end this power plant, we need to decommission it. Listen very carefully. So, and the cost of decommissioning is $1,000. For example, just for your example, the cost of decommissioning at the end of year 25 is $1,000. So what we do, first of all, we calculate the present value. First of all, we calculate the present value. So let us say, as the gap is very much, it's 25 years. So present value came out to be $400. Present value came out to be $400. Listen very carefully. This is all basic accounting, please. $400. So you know what you do with how you make this entry. You capitalize it. You write PPE. Okay. PPE debit and provision credit. PPE debit and provision credit. Okay. Now listen. Just think. Let us say on the same day. On the same day, not in future. On the same day, somebody told you that now you don't need to decommission after 25 years. Somebody told you you don't need to decommission after 25 years. Now you need to decommission it after 8 years, just 8 years. Now you need to decommission it after 8 years, and same decommissioning cost will be used. You don't need to decommission it after 25. Now earlier in 8 years. So now just think, now we have to pay the same amount after 8 years. Can you calculate the present value? Can you calculate? The distance is shorter now. The distance is shorter now. You better know financial management a little bit. So when the distance is shorter now, and now you will calculate the present value. So this present value will be, let us say, $600. This present value will be more. Now it will be more. You can try it. Using 25 years and then using 8 years, your present value will be higher. So now what does it mean? It means your existing number was 400, but now suddenly the whole decommissioning cost increases. So what you will do with this extra 200? See, you will make the same entry. You will increase your PPE by 200 and you will increase the provision by 200. Okay. You will increase the PPE by 200 and you will increase the provision by 200. So at one end, you will increase your PPE. On the other hand, you will increase your provision. At one end, you will increase your PPE, and the other hand, you will increase your provision. Two things. And now, as the life has reduced, as I said earlier, as the life has reduced, so now you will earn less. Only 8 years you will earn, not 25 years. So now, yes, you need to do impairment testing for that asset. Okay. Only this PP thing, only PP thing, assets. We do impairment testing for assets. Okay. Impairment testing for assets. Now you need to do impairment testing for asset. Okay. So this is the treatment. This is the treatment of, wait, let me check the requirement. Discuss how the following should be accounted for in the financial statement: the destruction of non-current assets and decommissioning of power plant. Another 4 marks. Believe me, this is all, whatever I've discussed, this is the solution. This is obviously you need to write in theory, but this is the solution. Okay. First of all, what I said, just write off the 250. The write off the 250, no need to do any impairment testing because the asset is destroyed. For that, remember, the manufacturing facility destroyed, zero, nothing will come out. So no value in use and no fair value less cost to sell. Okay, P&L debit and asset credit. And second thing, I discussed this decommissioning liability thing. Decommissioning liability thing with the revision of useful life. Okay. Now, just think 1 minute about all these things. 1 minute. Take 1 minute or 2 minutes. Wait. Now you have two more interesting issues. You have two more interesting, three more interesting issues. Listen, this is again the combination of IS 37, IS 37 and IFRS, IS 37 and IS 20 government grant, IS 37 and IS 20 government grant, basic standard. But yes, listen, Collard company has in the past repaired minor environmental damage that it has caused, but it has never suffered a natural disaster on this scale. Listen, yes, as we are operating, definitely we may create pollution. So then if we are creating pollution, listen to me very carefully, so we are damaging the environment. So in past we repaired minor, word C, repaired minor environmental damages. So this minor damage can't create a valid expectation. I'm talking about constructive obligation. I'm sure you guys know this. Okay. But this event, this type of natural disaster, this is the first time event. So no past history of such event with us. Okay. So no more constructive obligation now. There is no legal obligation for Collard company to repair and restore the damage caused by the disaster, as this will be the responsibility of the government. That's it. 3 lines, enough. Just discussed IS 37. You remember in IS 37, we only make provision when there is a present obligation. And you know, present obligation are two types. One is constructive and one is legal. One is legal and one is constructive. There is no legal obligation. You can read it clearly from the question. And the constructive obligation only arises when our past practices or our act or our announcement creates valid expectation to those affected, right? So my dear student, we have no such past practices. There's just a word minor, no such past practices. Listen, and plus this is the first time of natural disaster, so definitely no past practice not possible. This is the first time of the disaster. So no legal obligation as well as no constructive obligation, because we haven't done any announcement. We don't have any past practices, or we don't communicate through our act. So in this first paragraph, we are not responsible for anything. So no provision is required. Are you getting? Now listen. The government announced on 1st December X7 that there would be compensation of 50 million available to repair the environmental damage only, and that the companies should apply for the compensation by December X7. By 1st March X8, when the financial statements were approved, Collard company had only received acknowledgement, see the wordings, of their application, but no approval. The real thing is approval. Wait. Simple IS 20. You know, IS 20 says you can recognize grant in your books when two conditions are satisfied. Very famous dialogue, very famous. When two conditions are satisfied. IS 20 says, I repeat, you can recognize the government grant. You can recognize the government grant when two conditions are satisfied. Number one, when you have reasonable assurance, when you have reasonable assurance that you will fulfill conditions attached in the grant. Okay, and number 2, that the grant will be received. Will. I sometimes, because I teach junior students as well, I teach financial reporting of all levels. So when students study this standard first time, so how do I explain these 2 points? Listen, in the first point, IS says to check yourself. Reasonable assurance that you will fulfill all the conditions attached in the grant. Whatever conditions are attached in the grant, there are high probabilities that we will fulfill. So auditor will check us. Auditor will check us in point number 1. And the point number 2, that the grant will be received. That means the government authorities has also approved. The government authorities has also approved or issued a letter to us. Yes, we will give you grant. So the day we'll receive this confirmation, the day we'll receive this approval or confirmation, then we'll make the entry. Grant receivable debit, and P&L credit. Grant receivable debit and P&L credit. Grant receivable debit and P&L credit. Now some intelligent students may ask, sir, when we studied this standard, we made the entry deferred income. We credit the entry deferred income. Yes, even I taught you deferred income. Listen, the reason is deferred income we do when you have to carry on with that asset on the remaining useful life. This time you are getting for the past act. You are getting this grant for the past act, and which you have already done. The damage has already been done. The damage has already been booked in the P&L. Remember, the damage has already been booked in the P&L. So when the damage has already been booked in the P&L, so this thing will also go in the P&L to match. This thing will also go in the P&L in the match. Remember, the major concept is matching principle. So these are the 2 driving factors. These are the 2 driving conditions of IS 20. If you want to recognize grant, you must fulfill these 2. Now, students, my questions to all of you, one question. Do you think we have satisfied these 2 conditions by the year end? We haven't satisfied the second condition. We haven't satisfied the second condition. That's why we can't book this grant. That's why we can't book this grant. One student is asking why credit P&L. If whenever we make the entry in this question, we'll make grant receivable debit and P&L credit on the date of approval. Why P&L credit? Because we are getting this grant for the losses which has already been done, and which has been gone in P&L. We are getting this grant from the past for the past act. So now we don't need to do anything. To fulfill this grant. That's why P&L. So see this requirement, please. I just discussed this part. Point number 2, the cost of repairing the environmental damage. I just discussed, and the potential receipt of government compensation. Yes, somebody is asking if it was approved before the authorization of financial statement, before the signing off. Yes, this will be an adjusting event because at the year end the condition exists. We applied before the year end. Yes. Now one of my favorite, and I always give lectures for this thing, hedging. Listen, and this issue I have taught in my class. In my recordings, this issue is available. Yes. In my notes, this issue is available. Yes. In my PDF files, this issue is available. Discontinuation of hedge accounting. Discontinuation of hedge accounting. Discontinuation of hedge accounting. Believe me, I've taught this. They are asking only one case. I taught 2 cases in class. They are, in reality, there are 2 cases. And one more interesting thing, even in your Kaplan study text, this case is written. Even in your Kaplan study text, this case is written. This is the last thing I'm going to teach you today. Last thing. Hedge of commodity price risk in aluminum. Collard Company hedges commodity price risk in aluminum, and such transactions were classified as highly probable in accordance with IFRS 9 financial instruments. However, the purchases which were considered highly probable prior to the natural disasters are no longer expected to occur. First of all, can you tell me which hedge is this for highly probable forecast transaction? Which hedge accounting we do? Fair value hedge accounting or cash flow? Very good. Excellent. Excellent. Cash flow hedge. Yes. For highly probable forecast transaction, we do cash flow hedge accounting. For highly probable forecast transaction, we do cash flow hedge accounting. We do cash flow hedge accounting. We do cash flow hedge accounting. For highly probable forecast transaction, we do cash flow hedge accounting. Okay. Now, you have read this. You have read this. Now, yes. Excellent. Some students have given me the solution even, but I'll explain you. Don't worry. Listen, I'm using a separate proper page to explain this. Listen. You know, in cash flow hedge, for highly probable forecast transaction. First, let me revise. We are here right now. This is month 0. And we plan to buy a machine. We plan to buy a machine after 6 months. We plan to buy a machine after 6 months. And this is highly probable. This is highly probable that we'll buy this machine. Listen very carefully. This is the last thing. Now I'll end the class. Last thing I'm teaching you. That's it. Highly, we have planned that we are going to buy this machine after 6 months. Okay. But the issue is that our currency is, let us say, pounds. Our currency is pound, but this machine we have to buy from United States, so it will be dollar based. So just see the difference in currencies. So there is an exchange rate risk. Yes, we have a risk. First thing, yes, we have a risk. So now, to mitigate this risk, to reduce this risk, we entered in hedging instrument now. We entered in hedging instrument now. Okay, we entered in hedging instrument now, a derivative. We entered in a forward market bet or a derivative now. And now listen, why did we enter in this hedging instrument? All of you listen. Why did we enter in this hedging instrument? To reduce the risk of this hedge item. To reduce the risk of this hedge item which will come in future. To reduce the risk of that hedge item which will come in future. Remember? Okay. So now in this particular cash flow hedge case, the hedge item will come in future. Right now we have only hedging instrument. Okay. So now whatever fair value change, listen, whatever fair value change in hedging instrument, we will book in OCI. Or let me say the proper word, the effective portion. Now you are no more kids. The effective portion of this fair value changes of hedging instrument will be booked in OCI. Why OCI? Why OCI? Because the purpose of hedge accounting is matching. The purpose of hedge accounting is matching, and we have entered in this hedging instrument to protect that hedge item, and that hedge item will come in future. That hedge item will come in future. So the day that hedge item will come, the day that highly probable forecast transaction will occur, then we'll transfer this OCI into PNL. Then in future, we'll transfer this OCI into PNL. Okay, that's why all hedging instrument, all effective portion of fair value change of hedging instrument will go in OCI now. Okay, now listen. As we have planned to buy this machine, this was highly probable thing. Okay, listen, just use, let's assume the case of this question. We have planned to buy this highly probable forecast transaction, and we entered in hedging instrument before. So till this date, till this date, we booked $50 gain, $50 gain in OCI, $50 gain in OCI, and that $50 is basically fair value change, fair value gain of hedging instrument. Okay, but suddenly the disaster happened here. The disaster happened here, and now because of this disaster, we are crying. We have changed all our plans. Now we have openly told everybody that we are not going to buy this machine anymore. We are not going to buy this machine anymore. So just think, students, now this highly probable forecast transaction is not expected to occur. So there is nothing to match in future. Use your brain. There is nothing to match in future. So now what you will do, you will transfer this OCI into PNL immediately. You will transfer, let us say this is a gain OCI. So you will make the entry OCI debit now 50 and PNL credit. You will transfer this OCI into PNL now. And what's the logic? Because nothing to match in future. Did you understand, all of you? Did you understand? If you have studied normal lecture, definitely this is your second time for this topic. Students, did you understand? In this 4 marks, listen. In this 4 marks, you need to write that first of all, this is the cash flow hedge. This is the cash flow hedge thing. This is the cash flow hedge thing. Okay. And for highly probable forecast transaction, this is the introduction you need to write. And for cash flow hedge thing, as the hedged item, listen to me, all of you, hedge item will come in future. So the effective portion, effective gain or loss of hedging instrument is reported in OCI, because we need to match in future. Now, in the second line, you will write the application of this thing as listen to me, as this highly probable forecast transaction is no longer expected to occur. That's why all the previous OCI gain or loss of hedging instrument will be transferred to PNL immediately. And if you want to write the logic, you can write this, because nothing to match in future. That's it. Be relevant. Okay. So now, students, now listen, students, the purpose of hedge accounting is offsetting. Listen, this is also one very famous dialogue. The purpose of hedge, listen, the purpose of hedging is to reduce risk, no doubt. But hedge accounting, listen my words, hedge accounting is all about matching and offsetting. Hedge accounting is all about matching and offsetting, same period, same statement, same period, same statement. When I teach, I say these lines many times. Hedge accounting is all about matching offsetting, same period, same statement. Okay. Now listen, students, for current issue, read all the latest articles, or read all the latest articles. Plus, on my YouTube channel, I have posted latest current issues already. You can see. Even I'll send the link. Send the link on the group. Okay, so you can watch it. Okay, and keep sending the questions. Those who are registered student, they can send you the scripts to me. I'll mark them, and please do try to do practice on software, try to write it, so that, and try to solve in the last week, especially in the last 3 days, try to solve complete past paper in one go. Sit in a room, separate room, and try to solve the complete past paper, because some students said in previous attempt that we were not able to complete the paper. Even we were not able, time management issues. So better do a recce, better do a demo practice. Okay, so in this way you will have a third or fourth time in the exam to solve the paper, right? You can do it, and try to attempt complete 100 marks in the exam. This is the best advice I would give. Complete 100 marks, go for complete 100 marks. Okay, and try to go for easy marks first. You have seen, see, I have solved the latest past paper with you guys. And you have seen there are some easy scoring marks in this paper as well. So in each and every paper, these easy marks are there. And these easy marks will make you clear. Okay, even you can see the results of last attempt. Students scored 70, 65, 67. So obviously they are also human being. And even they also studied last month. One thing I would like to tell you, the lady who scored Pakistan top in the last attempt, that is June 2021 attempt. I still remember that was June attempt. He started studying on 28th April. I have the message saved in my phone. She told me that now I want to start properly studying. Will I be able to clear? I said, yes, 1 month is enough. 1 month, 28th April to 5th June or 10th June, like that. So when she can got position in 1 month, why can't you clear? Normal human being. Why can't you clear? You can clear. So be positive, think good, and stay in touch. We'll send you more resources. Okay. Take care. Thank you.